Hey everyone, and welcome to today's episode of Life Formula Podcast. With me, I have a legend. This man is full of energy, he's full of wisdom, full of good vibes and good energy and good spirit. Chris Panagiotu. And I can't wait to dive into this episode because I don't know about you, but I think money is important, and I think we should all learn and understand it at its basic level and go from there because whether we like it or not, money impacts our life all the time, daily, weekly, monthly, forever. And we need to understand the principles and how to capitalize everything in the whole finance space. And speaking of capitalize, Chris has a book written. It's a fantastic book. I went through it this morning. I'm going to go over it multiple times throughout my life and try to make sure everyone gets a hold of this book because it is a very, very, very well-written book, and I'm super excited that you wrote it, which thank you for writing this book, and I'm happy to share this book with as many people as I can. And that book is Capitalize Your Finances, the how-to financial framework that takes you from compoundingly clueless to monetarily magnificent. I like that. You got the two C's and the two M's, the alliteration there. Compoundingly clueless to monetarily magnificent. Fantastic. So, without further ado, Chris, how are you, brother?
Shaun, there is no place I would rather be. I just got back from vacation, which is funny. Like, for me, I've always had an interesting viewpoint on vacation because a lot of people love to go on vacations. Normally, I do. This one, I cannot wait to get back home, and I was just chomping at the bit. We've got so much exciting stuff coming down the pike through the rest of this year, and I get to kick off my August with chatting with you. So I'm in euphoria right now. That's how I feel.
I appreciate the kind words, and I'm super excited about this episode because I need to get my money on point, which is my intention for this episode, and hopefully for those people that's listening or watching to this podcast can take something from this episode and apply it to their lives to get their finances in check. So, first question.
Yes.
How important is money in our daily lives, and why should we care about it?
You know, it's funny. Most people, I feel like, would go to the obvious answer on how important money is. And it is important, and I'll get to that in a second. My mind immediately jumped to two people. One is a person that we have in common, Gautam Bade, who wrote The Joys of Compounding. And another is the person that wrote the foreword in his book, who I'm interviewing in September, one of my all-time favorite investors, Guy Spear. And the obvious answer on how important money is, it's extremely important. It's extremely valuable. If you do not have your money in check, your life will be ruined. I mean, let's just call a spade a spade. However, it's been interesting how I've been able to interview a lot of these super investors and celebrities that have done really well for themselves. And my wife and I have started to turn that corner, and which has allowed me to have the time to write this book. And we're also coming out with an online course later this year. But as you go through life and you start to build and compound your wealth and your health and your balancing of time, money, it is important, but it does not become the most important thing. When you don't have any money, money is extremely important. It's extremely valuable because it's an exchange tool for you to go and whatever you want to do, buy goods and services, go spend money on a vacation. You know, I'm married, so when I was trying to buy the diamond ring for my wife, not, you know, this thing was like $100, or now that we have a 6-month-old at home, and I'm thinking about making sure that her college is set up and someday our grandkids are taken care of and great grandkids, etc. But once you start to go on that path, like Gautam and Guy and all these super investors have talked about, it sounds really, really cliche, but I get what they mean by the most valuable currency there is time. And unfortunately, most people will not get to that part of you know, the wealth spectrum where they can feel that way. But that also has rekindled a new fire in my belly to continue to inspire those to not only understand the value of money, but to get to that point.
Cool. Yeah, it makes a lot of sense. I like that. So, why did you write the book, Capitalize Your Finances? Why did you write it, and who is the target audience? Who is this book for?
Okay. So, the first question is, why did I write it? So, first off, I've always wanted to do something with my initials, which are CAP, and my fans know that I'm the Cap and Capitalize. And early on in my life, I tried using it, and frankly, I was just kind of laughed at. And then also, I didn't really have any financial wherewithal or understanding from a business standpoint of utilizing the art of marketing. And I'll just tell you, this might sound kind of douchey, but like, it's pretty defeating when people like are laughing at you and you're just broke as hell. But it gets a lot easier for people to continue laughing at you when, financially you're doing better, right? Because it's like you don't care, right? It's like, well, why do you care? And so for me, the first calling was, okay, how do I utilize, my initials and my brand and because I get it, I'm a character. I mean, you can't not be a character and wear a shirt like this from Bad Birdie, right? But my thing was, I just wanted to utilize what God has blessed me with in some capacity. So initially, that's where the podcast came into play. And that was, one of the things that came from COVID. That's a long story. But over time, as the show started to grow, the questions began to pop up from my fans of, well, when are you going to write a book? Now, it's weird because I never told anyone I was already writing a book behind the scenes. But if I wasn't, I definitely was, if you know what I mean. Like, if you have fans telling you or asking for a good or service, you better provide it. Because generally speaking, if one is asking, there's probably 100 out there that want it, but they're not going to ask you because they don't have the guts to go and DM you or whatever the case is. So that's why I wrote the book. I wrote the book because I wanted to give someone a comprehensive framework that I utilize for clients. But I also am at this point in my life where I know I can't help everyone, but I want to. So now you have me without directly having me. So that's the reason why I wrote it. Now, as far as the target audience, we ran into an issue with this. Marketing's a beezy to figure out, right? Because you want your book to go to everyone, right? And it's the Harry Potter of finance, and everyone's going to love it. It doesn't work that way. Now, for me, I wrote it so that it doesn't matter where you're at in the financial planning spectrum of your life or the capitalized financial spectrum of your life. You can pick that up and roll with it. However, most of our audience is between 18 to 39, predominantly male. And these guys are obsessed with bettering themselves financially, which is the platform to allow them to better themselves in every other aspect of their life, whether it's their sales, whether it's their health, whether it's their comprehensive life, whether it's their marriage. And so it's for that. It's not just motivated 18 to 39-year-old guy, obsessively inspired 18 to 39-year-old guy.
Throughout time, as you created this whole entire brand, you created this book in your business, where did you learn this information from? Was it taught to you by family members at a young age? Was it taught to you by friends? Did you learn it by yourself? Did you learn from people like Robert Kiyosaki, Dave Ramsey? Which Dave Ramsey, I know you have a fun clip with that on social media, or anyone else. Who did you learn this information from?
Oh yeah. So that's a complicated question, but we have the time, so I'm going to answer it. So at the beginning, my family was a financially literate family. I have no relation with my father anymore, nor do I desire to. but he was a CPA and an attorney, and he literally worshipped the ground that Warren Buffett walked on, like to an unhealthy degree. And so ancillarily, I had a lot of that knowledge, but unfortunately, he was a guy that would lead you just to the edge of you about to understand something, and then somehow remind you that you know nothing about that craft. And so I knew ancillarily what was going on, but I was always kind of led. What was it? You know, you can only lead the horse to water so much. I was led to water, but then I just wasn't allowed to drink. And I was dehydrated. I was a dehydrated Clydesdale, right? Now, as far as how I began to learn what is capitalizing your finances, you know, I was really blessed early on that, you know, I took a stock class in seventh grade. We went to a small private school locally, and that was one of the multi-week courses. It wasn't anything substantial, but that kind of kick-started my journey. You fast forward, I was one of the youngest advisors in the world for Union Bank of Switzerland at 18. Went through college, went to Morgan Stanley. I just wasn't a corporate guy. I'm not going to knock them. They weren't my thing. And then I went to a company called Lucia Capital Group, which they're like family to me. You know, they flew up for my wedding, even though I'm no longer with them, and I spun off and created Capitalize Your Finances. We talk all the time. And that was the moment that I started to understand the world of financial planning. But even then, and this is no knock to my previous employer, but I looked at a lot of these advisors, and they were only focused on one segment, which was like pre-retirees or retirees. And that's your niche in traditional financial advice, because frankly, those that are about to retire have the most money. I mean, let's just call a spade a spade. But that just wasn't enough for me from a fulfilling standpoint. And I also was really, I was almost, it was like a combo of ultimate curiosity and then minute frustration in the fact that there really wasn't a framework out there that people could pick up and just know, oh, I read this book and I now know what I need to do for the rest of my life. You know, in investing, there's a book called The Intelligent Investor by Ben Graham. Warren Buffett's teacher at Columbia University. He's known as like the godfather of value investing, blah, blah, blah. That book is considered like the Bible of investing. Now, I'm a man of faith. I'm not going to say my book is the Bible of planning. But my goal was to set out and create the equivalent of what Graham did on the planning side. Because I'm trying to think 20, 30, 40, 50, 60 years down the road. And if I can have a ton of people, you know, they're going to get there in different ways, but they can circle it all the way back to, man, I read Capitalize Your Finances, and that set me off on the right path to whatever they decide to do. You know, in investing, there's certain investors called growth investors, value investors. I think that term's a load of crap, but they are there. There's real estate, there's private equity, whatever the case is. But they all kind of stemmed from Ben Graham. I don't know what that's going to look like on capitalizing your finances, but I know where it started.
Yeah, that Ben Graham book, I think I bought it 3 years ago, maybe 4, because it was one of the most popular books in the finances. And I'm not going to lie, I have like 300 books behind me. I tried reading that book, and it gave me like the biggest headache ever because the way it was written, I couldn't focus, and it kept distracting me. It was a really, really literate book, and I just couldn't do it. But who knows? I might study it in the future. But I'm glad your book is not written that way. Your book is written very clean. It's formatted really nice. It's easy on the eyes, and there's bold letters, and it's such a fun read. So thank you for writing a book that way, and not like the other book.
Thank you. Well, and Shaun, I don't want to interrupt you, but you're going to laugh. So when I was 10, I actually read The Intelligent Investor cover to cover. Now, I didn't understand a lot of it. Like I understood like 0.5% of it. And actually, if I were you, there's a version out there where it's The Intelligent Investor, but Jason Zweig, who's a really good financial journalist I've followed for years. He basically translates every chapter to, and I think modern day for him at the time was like mid 2000s. So that's still, you know, a little dated relative to today, but it's a whole heck of a lot easier than, you know, the original. And actually, if you think The Intelligent Investor is the most difficult, not to nerd out, I think the true financial nerds and students of our history in our industry would know that Security Analysis by Ben Graham and David Dodd is the true Bible of investing. Now, if you thought The Intelligent Investor was tough, dude, my eyes were actively dripping blood after reading Security Analysis. Like, that was the most difficult, dry read of my life. And this thing is huge. I mean, I have it somewhere around here. It's like 800 pages of just dense material written in the early 1900s. I don't wish that upon my worst enemy, but that's why I did it, so you don't have to.
Yeah, and I greatly appreciate it, because there is no way you would have to. I don't know what you could convince me to go back through that book and get past page 10, because it was a tough one for sure. It's a tough one. I can't. If you said the other one's even worse or even harder,
It's tough.
I can't even fathom what that would even look like.
Oh yeah,
But
at least 50 times more difficult.
oh god, why even write the book then? Like, you gotta know your readers won't enjoy this, so why even do it? You know. But continuing on. So I just thought of a really interesting question, which this may take some time, but I just thought of this on the spot.
Okay.
And I'm going to ask you which I just thought of interestingly, that I think are some critical points in people's lives. So the first one, at age 18, let's just say you just graduated high school. You may go to college, you may not go to college, you may go to the Army, or you might go to a trade school or whatever. Or maybe just go straight into a retail store or whatever. What would you recommend the mindset of 18-year-olds who just graduated high school? What should they be thinking about in terms of capitalizing their finances?
Two things. One, specific to 18 and those that just graduated, learn the basics of what we call capitalizing today as quickly as possible. You know, a lot of people like to get into the sexy side of money. And what do I mean by that? There's, you know, investing in stocks and real estate and private equity. And, you know, today everyone's an entrepreneur or a consultant, or it's not true, but like everyone says that they are. How many people could afford like a $400 emergency every month? Like hardly anyone in the United States. It's funny, I should know this because the fact is in my book and I literally wrote it, but it's very, very minimal. You also got to cut me some slack. With the 6-month-old at home, we just started sleep training, and last night we didn't sleep at all. So like I am running on empty. So if you start rattling off facts, right, I'm probably going to be a little buzzy, but it's neither here nor there. 18 years old, number one, get the basics down for capitalizing today. The second, and this is probably going to be universal for all of your age groups, you know, there's 3 forms that investors know about when they're analyzing a company. There's a balance sheet, there's an income statement, and a cash flow statement. Just to translate what those mean. A balance sheet shows what a company is worth. An income statement shows how much a company makes. And then a cash flow statement shows where the money is coming from, because companies can invest money as well, right? Now, the balance sheet, there's some controversy here, is what a lot of these investors would say is the most valuable form that you need to analyze. I go back and forth on that, but it's neither here nor there. There is a line item in the balance sheet called goodwill, and it's an asset. And it gives me a huge headache when I try to analyze a company's goodwill. Because what is goodwill? Goodwill is the difference between what something is worth and what someone else is willing to pay. Now, that's such a funky term, right? Because if no one's bought it, like, how do you know if there's goodwill and all that fun stuff? It's neither here nor there. Goodwill in real life is the most valuable asset you will ever have in your life. Period. No questions asked. So what I tell people is get the basics down, stat, and start compounding your goodwill today. And what does that mean? Steward of trust, steward of character. If you say that you're going to do something, by God, you better do it. And you better do it quick. And if you don't, you apologize to the nth degree and you triple down on what you need to do to earn that trust back, because it can be gone in an instant. Or if you said, hey, what can I do to best serve you, meaning the person you're talking to? Whatever it is, you do it. Whether, you're working at a store and you need to go back and get an extra pair of pants to, sell to the customer. Whether you are on a construction site and you need to introduce two architects to each other for whatever reason because you see the value in collaborating on this new building. The faster you can get into compounding goodwill, by the time you're in your 30s and 40s, there is no way your peers are going to be able to catch you in the success game.
Yeah, that is basically the quote that I remember, if correctly, is from Naval Ravikant. He said, goodwill compounds way faster than money. And I truly believe that. It's goodwill, just treating people right, helping them out, serving them. Well, not having the intention of getting something in return, but the universe or God or whatever you believe is going to give you something in return for your goodwill. So I really like that you said that. So we discussed some mindset beliefs or what things to implement when you're at age 18. The next age I would like to get your opinions on, your perspective on, is age 22 or 23, which would be just around the age of when you graduate college. Maybe they got a low-paying job from the beginning and trying to climb the corporate ladder if they're going that route. Or they just came back from deployment from serving in the military. What should be the mindset of that 22 or 23-year-old of how to capitalize their finances?
So in many ways, it's going to be the same, because the difference between 18 and 22, it's not a lot. I mean, in many ways it is, but in many ways it's not, right? Like it's 3 to 4 years. It is 4 years, but I'm rounding up and down and all that. So let's go with college. If you're just getting out of college, hopefully you got a major that isn't useless, and you've got a job that is, commensurate with the degree you have, and you're earning a return on your investment. That's why you should go to college. You should go to college because you should be able in the long run to calculate a return on investment. Okay? Every decision you make is an investment in life. Now, because of that, let's say that you've got benefits, like a retirement plan, and you've got student loans. You need to remember two things. Number one, the best investment you can guarantee is not an investment. It's the taxes you avoid. And then number two, remember the number 6%. Now, I speak about this in my book. And for your listeners, what do I mean by that? If you have debts that are above 6%, do I know in the long run with reasonable certainty that I can earn net of taxes 6%? Now, I believe I can. In fact, I know I can, but you can't guarantee it. Okay? And so it's all about getting the easy wins out of the way. And so if you got a student loan, let's just say one of the tranches are 10%. Dude, I'm not going to be able to guarantee you a 10%. And any person in our industry that says they can is a liar and an asshole. And I'm neither of those. So what you need to do is you need to make sure that you kick the snot out of that 10%er immediately. And that's assuming you're already putting in up to the match of your retirement plan, because that's free money, okay, that your employer is gifting you. Now, 10%, 9%, 8%, 6%, etc. That's where the snowballing comes into play. That's where I'm going to give good old Dave Ramsey a little benefit of the doubt there, okay? Now, 6% or below 6% for sure. Do I know in the long run that you can earn most likely more than that rate of return? Yeah. If you bought a home, let's just say in 2020, okay, and you have a 30-year mortgage at 2.99%, why in God's green earth would you pay that down faster? I would much rather have you capitalize on the spread, which in the world of capitalizing your finances, basically that means you're taking anything extra, which is what we call gap money, and instead of buying down a 2.99% interest rate, let's call it 3%, you would rather invest that in the long run. So if you're earning, right, you're taking that money to earn 6% instead of paying down 3%, you've capitalized the spread, you've just made 3%, like right there, okay? So know the number 6%.
Yeah, I'll get that tattooed on my arm, so I'll never forget the 6% in that aspect.
Absolutely. Or your forehead. You've got a good-looking forehead.
Why not? Thank you. Thank you. I think you might be the first person in human history to compliment my forehead. Well,
you are welcome. I will send you a bill, my friend.
Yeah, let's hold off on that for a little while. But something not to hold off on too. So we discussed ages 18 and 22, 23. Now, the last one I had in mind is age 40. And I think this is interesting to think about because if you take the average lifespan of someone in the United States, which they live between 75 and 80 on average, it's more like 78, 79. Age 40 is you're just entering or just entered the midlife of your whole entire life. And for most people, they're probably going to have kids. They might be managers at their, at their job. They may be still climbing up the higher ranks in their jobs. They probably have a mortgage they're paying on. So for most people generally, speaking generally here, that's age 40, what should their mindset be? Because they're probably 20, 30 years from retirement. Mm-hmm. Hopefully they've implemented these strategies within the past 15, 20 years that you've been talking about beforehand. So what should people around the age of 40, or give it to a couple years younger or older, what should they be doing with their money or thinking about what to do with their money?
One thing that I just thought of that'd be worth your listeners noting is, so like 18 to 22 and really up until like, I'd say 35. So there's good and bad with that. So I always tell people the bad news is you're probably not making as much statistically speaking as those that are older, which makes sense, right? Because on average, the more time you have in a career, the more experience you have, etc. And then you're worth more, whatever. So if that's the case, if you're not making as much, that means you're not paying as much in taxes. So there's a cool little thing in the tax code called the Roth option within your 401k, assuming you're working for a company that provides that. And that's the most common retirement plan out there, okay? If you're working for a nonprofit, it's 403B, and if you're working for a government agency, shame on you. No, I'm just kidding. That's a 457, okay? And so it doesn't matter what those big three are. Generally, you can put money in before taxes or after tax, known as Roth. So up until 35, I generally would recommend people hit the Roth button pretty hard, right? And put in that money after tax. And the reason is, theoretically, once you get to retirement and you've grown that money, because remember, you can't take your money out of your retirement plans until you're 59 and a half, let's call it 60. So by the time you've gotten to that point, the compounding of the tax advantage is a break even. So for example, Shaun, I'm going to use you. So you utilize everything that Capitalize Your Finances has to offer, and you get to age 59 and a half, and you are investing in your retirement plan, and you have, let's just say, $2.5–3 million. It's not out of the question. Well, if that's the case, let's just use 3 million. Right now, that tax bracket is, let's say, 24–25%. Okay, in the highest bracket. Now, I don't know what you're making right now, but if you're in your early 20s, let's just say you're not making 180 grand a year. Well, why would you avoid taxes today that are lower and then down the road defer it so by the time you get to retirement, suddenly you're paying more in tax? That doesn't make any sense. I think 10 out of 10 times everyone would be pissed off with that. So that's why Roth is really valuable. Now, once you get to 40, right, you start to turn the corner in the decade of your 40s and your 50s. That's generally speaking where most employees and or executives are earning the most. Owners, it's a different deal, okay? Employees and executives, that's where you're earning the most. And that's where you've got to really rev the engine. Well, if you're earning the most, that means you're in the highest tax bracket that you're going to be in, okay? So if that's the case, on average, why don't you take that money instead of putting it in Roth, you put it in before tax? So let's just make this up here. Let's say you are in the 30% bracket, okay? Statistically speaking, those that are in the 30% bracket today, by the time you get to retirement, you're generally in the 15–20% bracket. So right off the bat, you avoid 30, you pay 20, I just made you 10% in taxes you're not paying. Didn't even say a damn thing about investing, right? Just pure tax strategy. And so utilizing your 401k and being able to max that thing out, which in the year of our Lord and Savior 2023, if you're under 50, you're able to put in $22,500. If you're over 50, you can put in 30 grand. But the whole point is, until you max out your benefit, your retirement benefit that your employer is providing you, don't think about going anywhere else. Keep it simple, keep it lean, and keep it mean. Obviously, your employer is going to match you, right? Unless they decide not to. But even if they don't, like, that's neither here nor there. Let's assume that they are. So you're getting free money there. There's also simplicity because you don't have accounts all over the freaking place, and then it gets super complex. And then, in combo of both those two, you have a ton of time freed up in knowing that you don't need to think about anything until you max out your retirement plan. So what does that mean? That means that if you haven't done that, you still just keep climbing up the maxing out of the retirement plan ladder, which can result in you focusing on your family, your friends, your career. Because again, your goodwill is going to earn you more than any investment return. So that's number one. Focus on maxing out the retirement plan if you can. Number two, assuming you got a mortgage, right? Keep paying it. Keep doing whatever you need to. Between 7 and 15, right? You're not wrong. If they're younger, you may want to think about looking into a 529 plan, which is a college saving plan, if you have not already. Now, it doesn't mean that if they don't go to college, you're screwed, because you can also use 529 plans for private school as of a couple years ago. And then you can also use it for trade school, or like your master's or law degree or medical school, things of that nature. And then one really cool trick is, let's say your kid just becomes the next Elon Musk and they're not going to even need this money. What's really cool is you just keep them as the beneficiary. And then by the time your kid has kids, formerly known as grandkids, then suddenly you have a fun little estate plan built in by just switching the beneficiary over. So that's kind of cool. You don't need to pay a ton for it. So when you're 40, 401k, if you got kids and it makes sense, a 529 plan, if you haven't started, you need to do so. But as far as the mentality goes, 40's a little early, but once you get to the point where you're knocking on 50's probably the earliest, but I'd say 55 to 60, you need to have that mental switch on how money is going to work for you. So up until you get to retirement, I know I'm a little long-winded here, so I apologize, but I think it's valuable. Up until you get to that 55 years of age, you got one goal: grow your money as much as humanly possible, because you're eventually going to retire, right? There's 3 phases in life: accumulation, the hump, and decumulation. I talk about that in my book. Well, when you get to that hump and then eventual decumulation, what is your main goal of your money? It is not to grow. It is to maintain your standard of living and replace your income that was coming in from your otherwise previous job. Secondarily, you need to make sure that you're growing as well. Because just because you retire, that doesn't mean you're dead. So 40 is a little early, but start to think about the acceptance of, hey, my mindset of money is going to change here soon, and I need to emotionally prepare for that.
Okay. You know, I'm just taking that in because it was a lot, but that's super valuable. Hopefully, if someone is 40, 50, is listening to that, take that in because that's some valuable information you just gave us. And
yeah,
I have a opinion to ask of you. So it could be one or the other, or both, or neither, I guess. Answer it however you feel fit. Should people be focusing on, let's say they're entrepreneurs, right? Should they be focusing on creating more money or saving more money or both? And this comes from the thesis of what Alex Hormozy says: don't invest, which I'm stating from him, you know, don't invest in the S&P 500, invest in the S&Me 500, which for those people who don't understand is that, you know, don't put your money where you're going to be getting 5 to 10% or less on average per year in stocks or a trust fund. But you could be investing in your own personal skills, or let's say, for example, someone is a content creator and invest in a higher quality camera, which will in turn make them more money down the line. So that's like an analogy or example I could think of real quick. So what's your mindset on that? Should people be focusing more on like avoiding all the tax strategies, or should they be investing in themselves to be able to create more money, to create more wealth, or should it just be a balance of both?
So that is a phenomenal question. I have never heard of the was it SME 500? Yeah, that's clever. That is clever.
S&P 500 and S&Me 500. Yeah, Alex Hormozy coined that term because that's what he focuses on. He chooses the S&Me 500 because if you invest in, like, for example, getting a personal coach, or like you invest in reading these books.
Yeah.
You know, for example, like I recorded a podcast recently with Nick, a mutual friend of ours, is how we got connected. And if you invest $20 into a book and it's made Nick in return $500,000.
Yeah. Okay. I'm going to try to keep it concise, but I generally don't, so I apologize in advance. But I think this is going to be really valuable. So I'm actually reading a book. So let me backtrack a second. One of my favorite financial authors is William Green, and he wrote the book Richer, Wiser, Happier. William Green is not an investor. He is not like I guess what they'd call a super investor. He's a financial journalist, and he has interviewed all of the greats in our industry. And one of them that he interviewed is a not well-known investor, and he's done this purposefully. He's out of Minneapolis. Most people never heard of him. His name's Fred Martin, and he's a chartered financial analyst. He's done it for however many years, I think 40, 50 years or so. And he wrote a book, and it has not gotten hardly any coverage. I mean, it's with a publishing house, but like I never heard of it until William brought it up. Benjamin Graham, I'm looking at it right now because I'm almost done with it. And basically it describes what you just asked, but in a business's sense. So Warren Buffett would always tell, or he tells everyone this: the best investment you can make is in yourself. Now, you also got to know Warren Buffett is getting to the point where, I mean, the dude's basically dead. I mean, he is so old. And so for him, he doesn't care about the money side of it, really. Like, of course he does, because that's still what he does. He manages Berkshire Hathaway. He's very, very smart and articulate at it. His thing is his legacy. Now, he wouldn't tell you that, because he's very strategically political about it. I'm not knocking Warren here. It's just like, let's call a spade a spade. Now, when I was reading Fred's book, and I've read all of these investment books, right? But sometimes you got to read the same thing 40 times, then it hits you in the mouth. And you're like, oh, I finally get it. Mm-hmm. And for Fred's book, when you're growing a business, the most valuable investment that you can make is back in the business. And there are technical terms that you can use called return on invested capital, earnings per share, seeing that grow over time. You can calculate your research and development in your marketing and divide that by your profit. And then if you're earning, right, an increased rate of return, it's like, duh, like no duh, you're going to reinvest in the business. Now, eventually, all businesses mature. Now, who knows when that's going to happen? Who knows? But when that happens, what do you do with the profit? Do you reinvest into the business? No. Not any more than is required. Because when you do that, you're reinvesting in earning a lackluster return on your investment. Because it's not growing. So as a prudent business owner or a CEO or a CFO, if you're in a Fortune 500, what you need to do is understand there is nowhere else I can go with this profit other than sending it to the shareholder in the form of a dividend. Now, let's apply this to you. Should you reinvest in the SME 500 or the S&P 500 or both? I think in your 20s, it should be SME all day, every day. Now, you also got to understand, I'm in a little bit of a unique situation because with our business, I am a financial planner. I'm a certified financial planner by trade. And I also invest as well alongside clients. That's part of it. And for my wife and I've told myself once the business started to turn the corner, unless my wife and I have invested in that long-term strategy, I would not recommend it to a client. Because I just think that's prudent with what I do. Now, you also got to know this. I am actively losing as a return on investment for doing that. Now, people are probably like, well, does that mean our investments are bad? No. But let's face it. If I invest in a piece of real estate or a stock or a private equity investment, which, statistically speaking, those expect to earn returns of, they'll say 8 or 10, or sometimes they'll even say 15. I don't buy any of that. Doesn't even matter. My whole point is that they're going to earn you 8 or 10 in the long run, ideally, but I could take that money and reinvest it into my business and in 3 years get that principal back, which is a 33% return on my investment, which I know I could do. I am actively taking return off of my family's plate to be alongside my clients, because I think that's the prudent thing. Because someday I'm gonna have to answer to that. That's a unique business, though. That's a unique business. I think if it was anyone else, you reinvest as much as you can. But then comes a point where you've got to ask yourself, and that's where you get a CFO or a controller involved. And if they're worth their money, which most of them aren't, but if they're worth their money, they go, oh, we're not earning anything on this marketing or research. And like, we've done it. We've maxed it out, right? Like, what would be a good example? I'm not giving investment advice for those of you regulators lurking in the bushes, but let's just use a company that's old and mature. Okay. Hershey. Okay. Prime example, right? Again, not investment advice here. Do they really need to reinvent the wheel? No. It's chocolate. It's been the same chocolate for years. They might add a little bit more sugar. They might take out a little bit more here and there. You can only reinvent Reese's so often. You know, they're Halloween. You get a nice bump every year. There aren't really a ton of competitors, so you don't really need to market it. So why do that? And that's why like Hershey goes and they increase their income. You know, for years, one of my favorite investments, no longer publicly traded, was Wrigley's chewing gum. Loved it. Why? They spent squat on marketing because they didn't need to. And do you need to research and develop more? No, it's gum. Like, they didn't need to. So what they did is they literally had nowhere else to go. And their CFO, who was brilliant, I'm blanking on the name, he increased the dividend every year for like 80 years. And when the company, you know, stock was down for unnecessary reasons, he would buy back more of the shares, which means you and I own more of the company. So then when it does well, we earn proportionally more profit. And then when the company did really well, he would have that more of it sell off because that's just prudent business. And so you toggle with that. But then when it comes down to personally, you've got to do that same thing. But as an entrepreneur and a business owner, and this is what just grinds my gears, right? Because, you know, financial planners in our industry, they talk about all this stuff that they do. They don't have a clue. Like, here's what you need to do with a planner. You need to ask them, number one, what is in your portfolio? That'll shut a lot of them up really quick, okay? Number two, how do you manage your business? And let me tell you something. If these planners are not managing their own business and they're like W-2, find another one. Because as an entrepreneur, you want to work with like-minded people, okay? And then, you know, number three, you need to have that same conversation as an owner saying, hey, it might be me or someone else. When do I stop reinvesting into the business? Or another question, another variation is, should I continue to reinvest in the business? Like, am I doing the prudent thing? And if the answer is no, then you take distributions, then you invest in and again, not S&P 500, but the metaphor, and then you start taking distributions from the business and investing in other opportunities, right? Because if you're marketing, you're reinvesting and you're earning 0 or 2 or 3%, versus you could have a stock or a piece of real estate or privately owned business that's earning, I don't know, 8 or 10 or 15 or whatever the case is. Capitalize the spread, man. Take the 3%, buy an 8, you just made 5.
Have you ever read the book Die with Zero by Bill Perkins?
You know, it's funny. I have not, and I have a stack of books off to my right. And that book, it is in the stack, and it's unfortunate that it keeps drifting to the bottom of the stack because guests keep sending me books and friends keep sending me books. I was like, oh my gosh, I'm going to read it. I need to read it. I have not read it. People have told me I need to have the author on my show. I need to have that. But I didn't mean to go on the tangent. Why are you asking?
I'm asking because he has a different take on how to spend your money, which I tend to agree with and I really love a lot. He says, basically, I'm paraphrasing here, so don't come at me if I say it slightly incorrect, anyone who's listening or watching. But in his book, it's a cool perspective because he says the best money that you could spend is in what he calls memory dividends. And that's based on like experiences, right? It's because, you know, those memory dividends, you know, you hanging out with your boys and going on a trip to Las Vegas, or you going on this solo trip travel to Europe backpacking. he says that
Yep.
because when you're old and retired and stuff like that, what's really going to matter is the legacy and the experiences and memories that you've had throughout the whole entire journey of life. Which he's more of like, I want when I die,
Yes.
I want to spend all of my money and have nothing left in the bank account. Kind of like contrary to like what Warren Buffett has, like he keeps making more money, but it's like, but why? Spend it, enjoy life a little bit, you know. Um, he's kind of
Sure.
going against the
Sure.
opposite side of it. And how should people manage or think about spending money? Not, I wouldn't say material things because you know material things come and go. Like I don't need to buy. I don't think it's a good
Right.
idea to buy the newest iPhone every single year or the newest laptop or TV that comes out.
Yeah.
That's just not smart. But it's
Yeah.
like instead spending that money on like concerts with your girlfriend or boyfriend or taking a trip to Paris with your family members. Like
Yeah.
what do you think about that perspective?
So
With the gap money, that's also that's kind of like what the gap money comes in is where I'm coming from.
yeah. No, so I totally get the whole framework of the die with zero. Um, I also think you got to know who you are, and I'm not. And again, I haven't read it. I don't know the author. So I'm going off of very surface level stuff here. I can tell you, having a daughter, and also and again, this is very specific to just who I am in the business I'm in. Just put yourself in my shoes for a second. If I was just living it up, I can tell you without an ounce of a doubt, my business and client base would be a fraction of what it is today. And also, that just doesn't appeal to me. I think there is a balancing act, though. Like, I get what Warren Buffett is doing. Very, very similar to, like, I get the die with zero. I totally get it, right? Because you can't take it with you, etc. I get Warren Buffett.
But also, just to bring in some background to Bill Perkins,
Bill
the
Perkins,
author,
thank you.
he's also a guy who's worth hundreds of millions of dollars. I think he won it through maybe gambling or poker, or I'm kind of drawing a blank there, but he's made nine
Okay.
figures, so he's able to easily do that. It's not like the regular person that works a nine to
Yeah.
five. So that's a little framework
Okay.
there too as well,
And that
just to give you some
changes
more
things a little
context.
bit. But not tremendously, because then you've got, like, so Warren Buffett, his thing is, be a steward of the capital on behalf of shareholders. He never wanted to retire. He wanted his legacy to be, and it has been, one of the best compounding kings of all time. And he wants to give his kids just enough to be okay, but not enough where they can't do anything. Although I think his kids have done fine. Um, and they're going to work on the foundation, so like they'll be fine. Okay, but then you've got his mentality of, I'm going to give the majority of it to, um, society, because I don't need it. My kids won't need it, and I want my legacy to be shared for the greatness of the world and the future of the world. And he also has struggled with that his whole life, because he knows he can compound money better than the average person. Like, I think that's pretty obvious. And so why would he give money to a charity today when he knows that in 30 years, because these charities are going to blow the money, it's gone. Versus if he invested over 30 years, now you've got like a foundation of an endowment where you have generational wealth for these charities that have so much goodness. So, like, I get that framework. I can tell you kind of my mentality on the money side of things. Most people, when they retire, they've got the retirement plan, and they're able to ride off into the sunset. And if it's Roth and pre-tax, you can balance that. Um, I think for a lot of business owners, myself included, your 401k becomes a tax sheltering vehicle. And secondarily, you are investing it. Now, down the road, I get the Warren Buffett side, and so on the 401k side of things and or IRA, you have to take money from the pre-tax portion at 72. By the time we get there, it's probably going to be up to 80. Okay, because we're all living longer. Well, I know I'm not going to need it. Wife and I are going to be fine. So I would much rather take that money, and there's a rule in the tax code, not to bore you with it, but you can take up to $100,000 of whatever that minimum amount is. And it's basically 4% of what the value is. And you can give it directly to a charity. It's called a qualified charitable distribution. And it jumps over your tax return. So everyone wins, right? You give it to the charity or charities of your choice. So you feel fulfilled. Tax strategy, you just made whatever it is in the tax bracket that you're not paying. And, Uncle Sam doesn't get a dime of it, like, ever. Okay? Because you can control that, right? So that's the charitable side. But then over time, I think with like non-taxable money, there's a balancing act of you need to get the compounding going. Okay? But then after, let's say, like 10 or 15 years, you can look under the hood and maybe take your foot off the gas a little bit on the compounding focus. Because here's another thing. All it takes is a couple good businesses, or investments, and you're good. Like, investing is a very forgiving business. It's a very forgiving business. There's actually a quick, just a side note, and then I'll zip the lip here. In the 70s, there was this whole idea called the Nifty 50s. And it's basically the modern day FANG stocks. So was it Facebook, Apple, Netflix, Nvidia, Google, and basically Microsoft, where if you invest in them, you're going to be great, or whatever the case is. Well, the Nifty 50, there was controversy as to whether Walmart was part of that. Because Walmart went public in 1970. Okay? And so if you invested in the Nifty 50 and Walmart was included in that, which was, 2% of the portfolio, and every other company basically did zero from then till now, you basically would have done what the market would have done and slightly better. And that's with one of those investments, a 2% sliver doing well, and the rest sucked. So that should tell you don't have to be right often. Like, not hard. Okay? But I think once you have a couple of those wins, that's where you can shift your mindset and maybe have that more of a balance of, I've been to Paris a couple times. I don't need to go again, but you use the example, right? Fly to Paris. I really want to go to Barcelona or Portugal. We've talked about, me and my mom and me going to the Holy Lands, because that's really important to us. Or saying, hey, because we have a child at home. It's like, let's dump the baby to grandma's and let's take a week where it's just an adult trip where we can go and just enjoy ourselves. I just think it's a balancing act, and it's not a one size fits all. You just got to know who you are.
Yeah, there's no right or wrong answer. And there was an interesting stat, which I think I got from the Chris Williamson podcast, where, do your own research, or maybe you'd probably know this way better than I would. But I think he said that 95% of Warren Buffett's wealth came from after his 60th birthday.
Yes.
That's just something crazy to think about. Like, what are some other crazy stats that you could think of off the top of your head, if you have any, that would be mind-blowing to just the average or general person involving money? If you have any. I know I put you on the spot there.
Yeah.
I'm sure there's
that's
a lot in your book,
one.
and there's just a lot in general.
There are a lot in general. The Warren Buffett one, I remember reading that, and that it blew my mind. But then it also, like, when you understand the laws of compounding, it's statistically black and white. But then when you look at, like, his dollar amounts, right, it's absolutely wild. That should also, though, tell you something on the far, like, die with zero. So I always tell clients, think about this. So when you're just starting out and you have $0, okay, and you're putting in, let's just say, a couple $100 a month. So if that's $200 a month, $2,400 a year. Okay, so if you put in $2,400 a year, your contribution was the main driving factor. The next year, right, starts to compound a little bit. You put in 2,400. That's still a huge portion, but it's not as much. And then you keep going, you keep going, you keep going. Well, let's say 30 years down the road, okay? Let's just do the math. I got my calculator right here. So you put in 2,400 a year, and let's say you're earning 6% in 30 years. Okay, well, now it's grown to $189,000. So then you do that for one more year. Okay? That's 6% for 1 year. It grew to 203. Well, hold on a sec. Did that 2,400 move the needle? No. That was the early years of compounding that really moved the needle. So I think once you get to that point where you know, okay, I could still throw money at this thing, but like the initial legwork is done, and I can start to enjoy the fruits of my labor and compoundingly ride off into the sunset. That's when you can have a different outlook on life. I just think most people don't even think of that. You know, like I can tell you the last couple of years, I mean, my wife and I have put our money where our mouth is and invested prudently and I don't want to say aggressively, because when you attribute aggressive or conservative, you're investing with emotion. I don't believe in that. But if you're investing prudently, I can tell you, you know, some of my best friends, they've invested in furniture, clothes, very material things that aren't going to earn them a dime. And
Crypto?
no, none of that.
That's a whole
That's a
conversation
whole other
for another day
conversation
for it.
But just things that, like, because I think people our age, and yeah, I'm a little older than you, but not that much older. We live in a world where you want to appear as though you are successful. I think that's the stupidest thing in the world. You know, I think I would much rather, like, a lot of people dress like they want to just be like, you know, the next whatever.
Dress to
right?
impress.
Whether it's athleisure, whether it's the next best suit, whether it's a nice dress, whatever the case is. For me, like, people laugh at me, right? Like this is my only like business casual attire is Bad Birdie. Okay, I either go suit and tie, or I'm like in my Rogue gear because I love Rogue. Shout out to Rogue. And just athletic, not even athleisure. It's just like a dad that works out. Like there's no middle ground for me. And sometimes I'll even go to
working a dad bod officially,
right? And sometimes I'll go to these events, and people, you know, even like my wife would go like, "Man, like you didn't want to dress up a little bit?" I'm like, why? To appear as though I am? No, I know who I am. You know, there's an investor, Bill Miller, who, you know, he's fallen under some controversy as of late. I still look up to him. I think he's a brilliant investor, and his underling, Robert Hagstrom, I had on my show in 2022. Great guy. And I've never met Bill, but like Bill, one of his things is he doesn't wear tuxedos anymore. He just doesn't. Like he doesn't do black tie events. He's done. And he was invited to speak at a guest speaking event. And I guess it came down to, at the very end, Bill's like, okay, so like what's the attire? And they're like, well, it's a black tie. And Bill goes, that's not going to work. And they go, well, I mean, that's how it is. And he goes, okay, well, you're going to have to get someone else. I guess the host was like, are you serious? He goes, yeah, I'm dead serious. I don't wear them, you know? Now, granted, like, you know, Bill's a billionaire and he can get away with a lot of that. It doesn't even matter if you're a billionaire. I mean, as long as you're wealthy within what you need to be, you don't need to impress anyone. You've already impressed yourself. Now, it doesn't mean become cocky or arrogant. It's just know that you're living your true self.
Yeah, that's like the whole dress to impress thing. It's really interesting if you look at that dynamic, because throughout high school, you know, we're all students in the middle school and stuff like that. We judge each other off like, oh, you got the newest pairs of Nikes or Jordans, which like you don't even have a job to make
Mm-mm.
money anyway. So why are we even judging
Mm-hmm.
what you wear? And then you look at people like Bill Gates and Mark
Yep.
Zuckerberg and Elon Musk. They have no swag. They have no
None.
fashion whatsoever. They have none
Mm-mm.
whatsoever.
None.
And that's a really interesting dynamic on that. But it's like then some people have a big passion with cars, which I don't care anything about cars as long as it gets me to where I need to go. I don't care about detail on it. I don't even take it to the car wash. I let the rain come and
Yep.
clean it off for me.
Yep.
I'm that guy. It's like, but people have their own things. Some people really enjoy the fashion and some material stuff and experiences. But like what I'm saying is that the people who's listening, it's not good or bad. Thinking makes it so. Is what Shakespeare
Mm-hmm.
said. And just enjoy life. That's what it all
Yeah.
comes down to. You only get one life, and just enjoy it. Spend the money the way that you want it. And before I ask you the last question, I was just thinking about compounding earlier. I think Einstein said that compounding is the eighth wonder of
Yes.
the world, which I thought was a good quote from
Mm-hmm.
him. And one more example of compounding is the one I'm most familiar with in any area of life, because compounding can go into health and a lot of different things. Like for example, if you work out every day, you're gonna be strong in a couple of months and stuff like that. But my favorite compounding example was from The Compound Effect, the book by Darren Hardy,
Oh.
where you take the magic penny rule,
Mhm.
where you ask someone the question, would you rather have $1 million right now or have a penny on, I think it's a checkerboard, a
Yep.
chessboard, whatever. It's like 31 or 32 things of compounding moves. It's like, would you rather have $1 million today or would you have this penny or 1 grain of
Mm-hmm.
rice compound itself, double it by the end of the 31
Mm-hmm.
days? And then you get like a crazy enough, by day 20, you're at like a couple hundred. You're like, oh, I should have definitely taken the 1 million by
Mm-hmm.
then. Because you're 20 days in, you've got 10 days or 12 days left. It's like, oh, I should have took the $1 million on the first day. But then once you get to the end of the 30-second compound or whatever, you're at like $5 to $10 million, which is just insane. It shows you from just doubling.
Bodily health, which is it's as surface level as it sounds, right? Be healthy. Eliminate toxic people, no matter how painful that is. Pick a career, not a job, that if you weren't paid a dime, you would be just as fulfilled. Be incredibly mindful of the person who you are going to spend the rest of your life with, if you choose to do that with someone. And know that no one is perfect, including yourself. And master the understanding of knowing your greatest gift is your greatest curse. So if you are looking to pick up the book, Capitalize Your Finances, the how-to financial framework that takes you from compoundingly clueless to monetarily magnificent, head on over to Amazon.com, type in Capitalize Your Finances, the book. You can get it in hardback, paper cover. We are coming out with an audio later this month, August 2023, as of this recording. If you are looking to support the podcast, head on over to Spotify, type in Capitalize Your Finances, where we release a new episode every Monday, whether it's me interviewing celebrities from all walks of life, telling you how they have capitalized their finances in their field, whether it's me interviewing the best investors in the world, or yours truly, the Cap and Capitalize, teaching you how to truly capitalize on your finances for whatever that means. That's where you're going to want to tune in. And then if you are interested in the business, head on over to capitalizeyourfinances.com. That is my business. We do work with accredited investors only, which means got to be worth $1 million or make 200,000 if you're single, and or 300,000 if you are happily locked down, formerly known as married. But that's how you're going to find me. And then lastly, if you want to follow me on social media, head on over to Instagram. That's where we are growing. We just started earlier this year and we're growing rapidly. I'm also on LinkedIn and Twitter. And be on the lookout because December 1st, we are coming out with our online course, Capitalize Your Finances, where I'm basically taking my framework, injecting it with steroids, and giving you everything that you need to know in multiple videos, multiple forms, so you have me in your back pocket as if I'm already there.